Trevor, welcome back. Beat the Odds at Business and Wealth Podcast. We got another edition.
Another edition. Okay, this is going to be an exciting one. So let's dive in and see what we're talking about today.
Full panic mode. Bank of Canada, full panic mode.
They are in panic mode. But you know what? The government takes every opportunity to pat themselves on the back and say, oh, look at our interest rates are coming down. So well done for us. Well done. Let's not break our arm patting our own back here.
Because central banks always reduce interest rates because things are so great. That's why they reduce interest rates, right?
Yeah, so, they don't want to make money on interest, right?
So Trevor, did you unpack your new gun after last week?
You know what? I pulled it out of its packaging. I haven't cleaned it up and taken it out to the range yet. Yeah. But I'm so glad that we supported a local gun shop here because there's terrible things happening for gun owners. I guess some have already been visited by the government and they've had to surrender the back stock, the dead stock that they've had from the previous gun bans.
Really?
Yeah.
In Alberta or what provinces?
No, I'm not sure. I just briefly saw something on X there. But yeah, they're already starting to have to turn them in and they're being confiscated and
without payment.
Oh no, they get payment, but it's a pittance of what they've paid, right?
Okay.
So it's sad. But we bought some new guns and it was awesome.
It's fun. I got a new mug too.
Oh, did you?
Yeah, my team gave me this an early Christmas present. I'll bring it to the camera there, so let's see if we can see it well.
No, out of focus.
It's not gonna work out.
It's a meme.
Yeah, it's this is the price you deserve mug. So for all the no coiners who have to come in here, for their meetings after 2.5 years and me telling them and get off of zero, it's like I can just sit here and sip my coffee. While they tell me all their reasons why they're still on zero. So, but that's my fun mug.
Yeah,
so.
Yeah. That was by Michael Saylor. Says you get Bitcoin at the price you deserve.
That's right. We all do. So,
yeah.
Okay. So let's jump into it.
All right.
Bank of Canada. Full panic mode.
Panic mode. They're freaking out.
Mode.
Yeah.
Okay. So we see this here. We had 3 quarter-point basis cuts, and then we had 2 half-point cuts. Total 1.75. Okay, 1 point. And so you say 1.75 and be like, okay, it's 1.75. That doesn't rates were going to come down. I get it, right? But I want people to understand the historical significance of this. Okay, I'm going to give you a few instances. Okay, 1981.
Okay, what happened in 1981?
1981, the Bank of Canada reduced interest rates by more than 1.75% in a single year. Okay, keep in mind they were coming down from a rate of approximately 20%. So, 2% off of 20% is kind of like a quarter basis point or half a basis point cut today, right? Like on a proportional ratio, it's like it was in a nominal basis, it was big, but on a proportional ratio was not that big. Okay, so 1981. And that's kind of, coming off the end of the gold standard. The monetary supply increases rapidly, and people wonder why the inflation was so high. It's like because that's why they came off the gold standard, and all of a sudden, all this new money gets created. The M2 money supply just explodes, and guess what? Inflation explodes, and they jacked interest rates to the moon, and everyone was thinking, well, certainly that's going to happen again this time. They're going to jack interest rates to the moon, but they don't understand that the debt in the system, we have 3 times as much debt in the system that we had at that point. So 20%, interest rates would basically be Armageddon today. Like the system would blow up.
So everything would be destroyed.
Roughly speaking, 7% interest rates this time around was the same stress as 21% that time around.
Yeah, right? Because we have 4 times
as much debt. Okay, so 1981. And then you get 1990, the next time that the government actually reduces rates by 1.75% or more. What did we have in the early 90s? We had 10% plus unemployment. It was a major, deep, hard recession. Okay, fast forward to 2001, you get the dot-com bubble explosion, and you get people flying planes into buildings. Okay, that's the 3rd time they reduce interest rates by 1.75% or more. Then you move on to time number 4, 2008, financial crisis. This is the meltdown of the banking system. Okay. And then you get to 2020, global pandemic, the entire economy shut down. Those are 5 times. That is the only other 5 times in history that they've reduced interest rates by 1.75% or more in a single year. Mm-hmm. And we basically just did it in 6 months.
Yeah, so I mean, this kind of reminds me of that meme where you have that dog sitting and the room was on fire, and he's like, "This is fine. Everything is fine."
So I mean, I tell people like this is the place where you go to where we don't want to use the hyperbole just as the clickbait. So when I tell you Bank of Canada in full panic mode, it's really full panic mode. Like this this sort of rate cut only comes around once in a decade. This is time number 6 in, call it 53 years since we went off the gold standard. So. It's a big deal.
It's pretty significant.
It's a big deal. It's a real thing. Okay, why are they doing this? Why are they in full panic mode? Okay, first of all, we see the Canada prime rate history, and we're at 5.45%, and basically get down to, call it 4.5%. 4.45%. You start getting into the 25-year average prime rate. And I think we've talked about it on this show before, where most of the banks earlier in the year were projecting that we would get back down to 4.5% prime rate of interest by the end of next year. And I was telling everyone, I was like, yeah, that's a reasonable projection, but I'd take the lower on that bet. And I think I've said it a few times before. I would take the lower on that bet. And I'll show people why, again, I would take the lower on that bet, okay? But what else are they looking at? Their job is to maintain price stability, a CPI, okay, and to maintain full employment, okay? That is their mandates. And we look at, here are the full-time jobs, okay? From the beginning of the year, you have 16.6 million full-time jobs, and then at the end of the year, 16.9 million full-time jobs. But what do we know about our population increase? About a million.
A million a year. That's
mostly
crazy.
Through immigration, mostly of working age. So you get a million people coming in, and only 300,000 of them actually have full-time jobs. It's like not great. And you can see wages have absolutely flatlined.
It's been flat pretty much the whole year.
You have 75 cents on year, but really there's nothing since February.
Yeah,
$30 an hour since February. That's the median income in Canada, and we all know that median income is propped up significantly by government jobs. We know that number in the public sector is paid higher. So, so we have 16.9 million full-time jobs. But we dig deeper and we started putting this chart in because we all knew this to be true, but we're going to make this part of our monthly information that we look at is the public sector versus private sector jobs. And you'll notice if you go through the StatsCan jobs, very easy to establish full-time versus part-time jobs. Relatively easy to establish public sector versus private sector jobs, but good luck trying to find public full-time jobs versus private full-time jobs. That's a more obscure number that's reported on less often, okay? And I think for good reason. They don't want to, makes it a little easier for them to, hide weakness in the labor market. But you start seeing this and look at what has happened, particularly in the last 3 months, okay? You have seen public sector jobs go from 4.2 million to 4.5 million, a 300,000 job increase. At the same time, you've seen private sector jobs decrease from 13.8 million to 13.5 million. So, it would look like we have the same number of jobs, but in reality, the private sector has laid off 300,000 people and the public sector has hired 300,000 people. So
now, maybe explain to people why that's a problem.
It's the old, the power adapter plugged into itself. Like you can't run an effective economy if everyone is working in the administration of that government, right?
And where have we seen governments operating like this before? It's very Stalin-esque. Everyone works for the government. Everyone gets paid by the government.
Yeah.
It's terrible if the government controls all industry and everything. That's going down the road of socialism/communism.
Yeah, that ratio should be like 10 to 1. Even historically, it's been like 5, 6, 7, 8 to 1, right? But it should be 10 to 1. And, in the last 5 years or so, it's like 3 to 2, 3 private jobs for every 2 public sector jobs. And it's
scary.
It's just like, think about your business that you work in. It's like you have 2 secretaries for every 3 people in the field. Like it doesn't work that way. Like you can't run efficiently that way. But this is last 3 months. It's like full panic mode. It's like, yeah, you're seeing an increase. That basically there were no more new jobs.
Yeah,
like we lost 300,000 jobs, and rather than take the L, we simply tack those onto our deficit and our debt, and let's put them on the government payroll to make it look better, which we're finally going to get an answer next week, apparently.
Oh, yeah, this should be very, very exciting. I think we need to put a poll on X or maybe on Instagram as to how far over budget did Chrystia Freeland screw up, or the Liberal Party screw up the budget this last section.
Yeah, the rumors are expected it's not 40 billion, it's going to be 60 billion, but will it be more, right? Will it be more? They're going to release it 2 days before they go home for the year. So
I think there's going to be some creative accounting going on there.
Yeah, and they know what it is, right? Like Tiff Macklemore, he knows what it is, right? And so he's reducing the interest rate. Like they know what's coming. But that will be interesting. And I always find it kind of interesting. It's like the government of Canada has a March year end. Mm-hmm. And if you're a private business in Canada, we get 6 months to file your corporate tax return. But the government can just, lollygag around and, they can, file it sometime in October or sometime in November. It's like, why can't I do that? Like, why can't I just call up CRA and tell my clients, like, we're not ready. Our 6 month, you've given us 6 months, but we're not ready. We're going to take a little bit more time. How much? I don't know. Just some more. Just some more time. Why? Filibusters. Filibusters are happening. It's just kind of clown world. You can't really take it too seriously because it'll drive you crazy. So, okay, we know this is happening, and the goal is how do you position yourself? What is the ultimate outcome? And I can hear it. I can hear it winding up in the background, and the ultimate, how are they going to pull themselves out of this, out of this productivity funk? Okay,
they got to fire it up, man. They got to fire it up.
I'm going to go through the things that it's not going to be.
Sure,
right?
sure.
People think that the 1 million immigrants a year that we brought here who are entry level workers are suddenly going to, fast forward 10 years into their career where they're highly productive, highly skilled people. Okay. That's not going to happen. That's not going to happen in a year. That takes a lot of time for that to happen. Okay.
Well, we got to teach them to not go to the bathroom on the beach.
That's that one's not going to happen. And it'll happen eventually, but it just can't happen in a shortened time period. In fact, it can't even happen in one term for a prime minister, even if there's a new election. It's like people get highly skilled in their job because they work at their job for a decade or more. Like that's how they get skilled in it. Okay, so it's going to take a long time. And then we know that we have a productivity issue in Canada, and the productivity issue, I've try to yell it from the mountaintops, is the businesses here, they do not have the equipment that's necessary. Okay, they do not have the equipment that's necessary. Our capital expenditures that happen in this country are far, far lower, like on a per employee basis, than certainly the U.S. Way lower. But even our G7 peers, it's like we spend less on capital expenditures for business per worker, than most. Okay, and that's the problem. So, how are they going to get this thing rolling in the right direction? They're going to do what they always do. They're going to print some more money.
They're going to print it, man.
They're going to print some more money, okay? Because ultimately the government, the central bank sets the short-term lending rates. The market sets the long-term lending rates. And, who's going to want government of Canada bonds at, 2 or 3%? Who's going to want it?
Nobody.
Central Bank of Canada is just going to buy them. They're just going to buy them.
They'll buy them, and they'll make the banks buy them, right?
So what we're going to see is you can just hear it winding up in the background, and it's like it's not an electric Tesla. It's a big V8 with the carburetor, and like you can hear someone they just fired it up in the driveway, and it's gurgling, and it might stall a little bit, and they might gotta put some new spark plugs in it, and get it going again. It's like the money printer is coming, and that is the only way out in any sort of politically tolerable way, and it does not matter who gets elected, that is going to be the outcome. Because why are we here? It's let's, if we can look at this one here, it's pretty small. It's like I go back and like tell that story. It's like, what happened in the 80s? Why was CPI so high? It's because the money supply explodes. The M2 money supply explodes when we come off the gold standard. Everything changed in terms of the rules and regulations around fractional reserve banking. Like, this is the birth of our new modern system. And so M2 money supply explodes, and then delayed fuse 24 months from that explosion, you start to see the explosion in CPI. Okay, so you're going to see the explosion in CPI, which is the fake inflation, not the real inflation, when you look at gold, but the fake inflation of the consumer goods based on what the government tells us we should buy. Okay, and that kind of continues, and then until we get up to you can see we never got up to that same rate of M2 money supply increase again. Okay, so you can see some examples where it got a little bit higher, and CPI remains elevated in that period of time. You're seeing increases of 10% and CPI increases of, let's call it 4.5%, 5% in that time. And then you see the 90s. Okay. Then you see the 90s, and like, what is the recipe for that? If you keep the M2 money supply low, yeah, you will keep the CPI low, but is there the political will going to be to exist to have unemployment for 10% for a decade? Like, is that political will actually go? There's no chance. Like, there's just no chance that is going to happen or last. It's like the M2 money supply, like, the printer is coming. Like, we know the printer is coming. You fast forward to 2020, and like, why was the CPI print so abrupt? It's because they increased the money supply by 18% in 2020, which was the single largest annual increase in 40 years. Okay, the last time we increased the money supply by more than 18% in a single year was 1980. Okay, you can even see in the financial crisis, you went to 14%. Not 18, and I tell people increasing the money supply is it's like a cup on the end of a table, okay? It's like the cup on an end of a table. It's like if you push it just too far, it'll balance over that end of the table. But just one more push, bang, there you go. Like that's what's going to happen. It's a very delicate balance, okay? And so it was a very kind of predictable result. You increase the money supply by 18%, and then all of a sudden you get the big CPI. But just look at what has happened in the last couple of years. And so the historical average in the last 53 years, let's call it, has been 8.3%. Okay. But if you parse out what happened, if you just look at the last 25 years, you get a historical increase of 7%. Okay. So this is a technical topic, but bear with me because this is really important for how this works. So you get the 7%. Basically, I would go with the 7% as your baseline because that 8.3% includes the rapid expansion after the end of the gold standard in 1971. So that was not a normal period. It is in our modern period of after 1971, but it was extraordinary, and that was the rapid increase in the CPI prices. That was the reorganization of the banking system. We're no longer on a gold standard, so all the rails were off. Okay, that worked its way through for a decade. Okay, once that worked its way through, now we're looking at 7.1% increase in the money supply. Okay, so if you have a 7.1 increase in the money supply, you have a population increase by about 1%. Okay, I think it's 1.2 on average, but let's just call it 1 for sake of an argument, round number. So let's just deal with 7% there. You have a 1% increase in the population supply, and you're trying to hit a CPI number of 2%. Okay, so what you need to do in order to hit a 2% target inflation, like if you just like rough grade school math, it's like if you have 2% CPI inflation, that is your goal for 2%. And you know you're going to have population growth of 1%, you would think I need to increase the money supply by 3%, okay? By 3%. But that's not what happens, is because the people with the most access to the new money, which are the people who can borrow money, and I always tell people the system is set up to move the money from the people who do the work to the people who can borrow money effectively to buy desirable assets, okay? So the rich people who can borrow millions, they'll put it into desirable assets. So when you need to increase the money supply, because they don't, if I make more money, I'm not going to change my grocery shopping habits. Like that's just not what's going to happen. I'm not buying more groceries. I don't need any more gas in my truck. Like those consumables that play a big role in the CPI, the people with the access to borrow the capital efficiently, they're not using it. Like that's not where it's going. They're going to put it in desirable assets. They're going to put it in real estate. They're going to put it in stocks. They're going to put it in gold, and they're going to put it in Bitcoin. Like that's where that capital is going. Okay. And so if you increase the money supply by 7%, you will get, you need a little bit to offset there's more people entering the economy. They're going to continue to grow the economy by 1%. And then you're trying to hit a 2% inflation target. Where does the other 4% go? The other 4% goes into desirable assets. And that's what drives the asset prices up higher. That's why you see the CPI, which they tell us has an average rate of 2% going up, but then you look at the price of a house in Vancouver and it doesn't go up anywhere near by 2%. That's why you look at an ounce of gold and it goes up by 9% a year. The gold is no different, okay? Mm-hmm. It's just the excess capital goes into desirable assets because the people with access to the capital don't buy more consumable goods, they buy desirable assets, okay? So that's important. And we have to understand what happened after COVID is you have a really restrictive monetary policy. So we're at 3.8%, okay? Let's call it 4%, okay? Let's call it 4%. I think these the 2.59%, that's I believe that's October. I think October is the most recent number we have there. So like it's not completely up to date. So I would assume it's a little more. Let's call it 4%. But that average in the last 3 years, 4%, is not enough to maintain the CPI. It is extraordinarily restrictive at the end of the day, okay? You cannot print 4% new money and expect CPI to be at 2%, okay? You are going to have contractions. You are going to have wage contractions. You are going to have price contractions. It's like that is what happens, okay? And so you can see this like zero wage growth. And it's not actually zero wage growth if you were to parse out the government jobs. Like that wage that you're seeing there is being propped up by the growth in the public sector jobs. If you were looking at just the private sector jobs, those wage rates are going down, okay? The wage rates are going down. That's what's happening. So there is only one way out in any sort of politically acceptable timeline, because people think that, you could do this with so-and-so gets elected. It's like, no, like if you did it that way, that person would be up for re-election and up for re-election possibly a second time with double-digit unemployment and trying to get re-elected. It's like, it won't work. They will print the money to save their jobs. Like that is going to be the outcome. Now, we no longer know, how the viewers of this show, like how you should think about positioning yourself is like, we used to, think that there should be a pullback, okay? Like we used to think that there should be a pullback, but the central banks are becoming more and more efficient at injecting liquidity when they want to. They started the experiment in 2008, and you could see the efficiency of how they did it in 2020. And they propped up the economy. Like, what did we see? A 20% drop in the TSX at that time? It should have been 50. Everything was closed. It was like a catastrophic event, right? Like everything, businesses were closed. People were locked in their house and the stock market only goes down by 20%. It's like, that is like, it should have been far, far lower. So everyone is looking at this expecting a major drop off in asset prices, which would be reasonable if we were operating in a true free market economy. But the government is going to inject liquidity, and you're starting to see it. Like, how do they inject liquidity? You reduce rates so more people can qualify for financing. Basically, once you get mortgage rates down to 3%, now you're starting kind of the max qualification for normies, because the stress test always uses the greater of your contract rate plus 2% or 5%. So once you're down to 3, you're going to use 5 either way, whether it went to 2.5 or not.
I think it's 5.25.
5.25. 5.25. Okay. Yeah. So so once you get your fixed rates down to 3.25, you get to max qualification for normies, right? But you have to realize that there's rich people, they could go out and get the financing today. They're just like, how much am I going to get paid? I'm going to dump another $1 million into my investment portfolio. Right now, I'm going to borrow the money at 6%, and the historical rate of return on these stocks is 11. It's like, I'm not interested. But once the historical rate of return is 11%, and they can borrow the money at 2 or 3%, now all of a sudden you start to see big injections of leverage positions going into this. It's like, okay, I'll go buy another rental property if I can borrow the money at 2%. There's a tremendous amount of capital like that on the sidelines that will all of a sudden become unlocked, right? And in a normal situation, you would expect there to be a correction and then to happen. But the problem is with the way governments inject liquidity and artificially directly affect the short-term interest rates, and artificially actually affect the long-term interest rates too, by buying the bonds, by monetizing the debt. It's like you're going to see an explosion of asset prices. The only question is it a grind up? Is it an immediate grind up, or is it a V-shaped, like bang and then up, like in COVID? I don't know the answer to that, right? But me personally, it's like, I'm not going to sit on the sidelines waiting for the V shape, because it's just as likely as it just continues to grind up, right? And you can see this in the U.S. right now. It's like they're trading at, the S&P 500 trading at like 30 times earnings. 30 times earnings. That's insane. If they weren't expecting, injections of liquidity, that wouldn't make any sense. But the market has come to the realization that we no longer operate in a free market. We basically operate in a market that's controlled and manipulated by the central banks. So it's just as likely that you would have the grind up as the V shape and then the explosion up. But either way, the direction is up and to the right of the desirable asset prices because of the injection of the money. So with that in mind, like for our audience, we're typical average small, medium-sized business owners, or people wanting to get into business, people wanting to build their wealth. What should they be doing right now? Like what advice can you present to them to start looking at doing for their investment portfolio? What is your thoughts on that? Consistently acquiring high quality assets, like consistently not aggressively. Like this is not one of those times where, I'm really leveraging up at this point in time, but this is like consistently acquiring assets, because the problem is like, the explosion in asset prices is closer now than it was a year ago. Like we know it's there because the pain is there. We just don't know the direction of here, V, and then up, or grind up that way. It should, in an unmanipulated economy, here, V, and then up slowly, but we're not dealing with that. So in this outcome where there's going to be a significant injection of liquidity, is it going to be up, V, and then up, or just grind up? But either way, you can't predict that. So you have to turn off the fear porn. You have to realize that when you hear the drastic job numbers and they're bad, and you hear bad economic data, that what you should hear is not sell my assets. What you should hear is like, I can hear the money printer warming up in the background. I know it's coming. And if you have that patience, but you just have to have that resolve, because as you're acquiring, you might force the V and then the explosion up, right? And so that's like probably, the mindset people should have. It's like, they see the Canadian dollar at 70 cents on the dollar, and like, could it go down to 65? It's like, yeah, it could, but it's going to trade at higher than 70 cents on the dollar again in our lifetime. Like, that is going to happen because the world needs our natural resources, right? Whether it happens with this administration or the next or the one after that, like, it's going to trade. So when you see like Canada at 70 cents on the dollar, that's not the time to dump your Canadian stocks to buy U.S. stocks. It's like, they're on sale now, okay? Like, they're on sale. You have to understand that that's kind of where we are. So that's like position number one, is like, you just have to understand that the worse the economic news is, the closer you are to aggressive money printing, right? We've already seen changes in the mortgage rules happening for legal basement suites, because it's not just rates, it's the access to credit too. Yeah. So it's new ways that you can access credit, different lending requirements, because if you reduce rates and just made the qualification process really difficult, you would not increase the money supply at all. Okay. Not at all. Reducing rates is one way, but usually there's going to be more ways to get financing, more programs, more insurance regimes, less down payments, that sort of things, special loans for special types of projects or properties, like, that's going to happen. Okay. Then there's the other person who maybe is a little bit more successful, a little bit further along, where the V could be coming too. Like, so there's two ways. It's like, this thing grinds up and to the right because of consistent injections and liquidity of asset prices, despite the bad news, okay, that you're hearing in the economy. Or you have the V type, go back to what happened to asset prices in March of 2020, and you see that V type. So that person should, if you have a little more, you should be starting to think, what are my access to credit? Do I have a property that, is below 65% loan to value, that I should have a HELOC available? Because they're so quick now. Like, it was shockingly quick in COVID, how quickly we went from, 20% down back to full scratch again. Like, you might not have had, if you blinked, you might have missed it, right? So having readvanceable products set up, having HELOC set up, having margin available in your account, it's like, you want to have those facilities available and ready to go, because that V, it's like the indicator I'm looking for, everyone has to decide, but the indicator I'm looking for is a 20% correction off the top. Yeah. Okay. That would be a reason why I would deviate from my regular, predictable acquire assets slowly over time, where, I'm going to get something a little bit more, right? But it's those opportunities are so few and far between, right? In my, I've been trading stocks since 1998, okay? That's only happened, once in 2001, once in 2008, yeah, and once in 2020, okay? And in reality, it's like, I wasn't experienced enough to recognize it in 2001, okay? And in 2008, I was distracted. I was an articling student, and I was distracted, and I wasn't paying that much attention. And it was only the second time it happened in my lifetime. When it happened in 2020, I knew exactly what was happening. And everyone's out there buying toilet paper. I'm just like, this is the easiest trade ever, right? So you have to have your credit facilities set up, because the system is designed to move the money from the people who do the work to the people who know how to borrow efficiently to buy assets, okay? So I wouldn't be taking big amounts of leverage yet in order to purchase, but I would have those facilities set up, because it could happen and recover very quickly.
Right on. Awesome. What else are we going to be talking about today?
Well, I think that's pretty much it for this time, Trevor. So we'll tune in next time, and we'll probably the government of Canada will be gone home, but we'll have those financial statements, and maybe we'll have some information about what they spent our money on this year. So
all right, well, next week's going to be a banger. If you guys are interested in checking out any of these charts or stats that Josh is sharing, go to Instagram and follow @SpurlCPA, and you can get all of that information. Give them a follow. We'll see you guys on the next podcast.